Ever seen a line of dominoes fall? You knock over that first one and suddenly a chain reaction takes place with each domino toppling the next. Now imagine if your money could work like that. Well, it can be done with dividend investing. When you invest in dividend-paying stocks, you start collecting small payments known as dividends. But here's where the magic happens. When you reinvest those dividends, it sets off a domino effect in your portfolio. Each reinvested dollar leads to even more payouts, which in turn creates more opportunities to reinvest and grow. Before you know it, you've got a powerful, unstoppable chain reaction, also known as the snowball effect. In today's video, I'm going to show you and John how you can start the dividend domino effect and use it to build wealth over time. I'll show you how to make your own perfect portfolio, and in the end, I'll show you how my portfolio strategy with snowball effect can help you and John to turn 10 grand into $9 million. So if you've ever rolled a snowball down a hill, you know how it starts small, but as it picks up more snow, it grows and grows, getting bigger and faster with every rotation. That's what happens with dividend reinvestment. What starts as a small amount of money can eventually turn into something much bigger, thanks to the power of compound growth. Let's say you start with a stock that pays you a small dividend, maybe 0.5% dividend yield. It's the percentage of the stock price that a company pays out in dividends each year. In the beginning, those dividend payments might not seem like much. Perhaps you earn $10 or maybe even just $5. That's not going to change your life, right? But here's where the magic of compounding comes into play. Instead of spending that $10 or $5, you reinvest it by buying more shares of the same stock. Now, the next time dividends are paid, you're earning on a slightly larger base. And as you keep reinvesting those dividends, your share count increases. The more shares you own, the more dividends you receive. And it just keeps building and building. Over time, this compounding effect can snowball into significant wealth. It's not about getting rich overnight. It's about setting your investments on a path that grows steadily over time. Take $10,000 in a stock with a 4% dividend yield. In the first year, you'd earn $400 in dividends. Instead of spending that, you reinvest the dividends to buy more shares. So next year, you're earning dividends on $10,400 instead of just your original $10,000. Each year, your dividend income increases as you reinvest those payments, and the power of compounding starts to kick in. Here's how this could play out over time. After 1 year, 5 years, 10 years, 20 years, and 30 years. As you can see, even though your initial investment was $10,000, after 30 years of reinvesting those dividends, your portfolio grows to over $33,000. One famous example of this is Warren Buffett. Most people know him as one of the richest people in the world, but what's less known is that a big part of his fortune is thanks to dividends and reinvesting them. Take his investment in Coca-Cola, for example. Buffett's company, Berkshire Hathaway, bought about $1.3 billion worth of Coca-Cola stock back in 1988. Today, that investment is worth over $24 billion, and Berkshire Hathaway collects roughly $700 million in dividends from Coca-Cola every single year. That's more than half of what he originally invested, just in annual dividend payments. This incredible growth is thanks to the power of compounding and reinvesting dividends. And listen, if it's good enough for Buffett, you can bet it's a winning strategy for building wealth over time for all of us. So how do you get started on this wealth-building journey? The first step is choosing the right stocks. Not every company pays dividends, so you'll need to focus on those that do. Generally, you want to look for well-established companies with a history of consistent dividend payments. These are often found in industries like consumer goods, healthcare, and utilities. Companies like Procter & Gamble, Johnson & Johnson, and Coca-Cola are often at the top of the list for dividend investors because of their reliable payouts. When starting out, you need to know that you don't need a fortune to begin dividend investing. Even small, regular investments can grow into significant wealth over time, especially if you reinvest your dividends. Many brokerage platforms now offer fractional shares, meaning you can start with just a few dollars. Over time, as you reinvest those dividends, the snowball will begin to pick up momentum. Now let's talk about selecting the companies to build the perfect dividend portfolio so that you can enjoy the snowball effect. While there's no one-size-fits-all approach, there are some guidelines you can follow to make sure you're setting yourself up for long-term success. First, diversification is key. Just like you wouldn't want to bet all your money on one horse in a race, you don't want to put all your money into just one stock or sector. By spreading your investments across different industries like healthcare, technology, utilities, and consumer goods, you can protect yourself against market volatility. If one sector takes a hit, your portfolio won't be devastated because you've got investments in other areas to balance things out. Next, think about your investment timeline. If you're younger and have time on your side, you might want to focus on companies that have lower yields but higher potential for dividend growth. These are companies that may not pay out huge dividends today, but they're consistently growing their profits and increasing their dividend payouts over time. On the other hand, if you're closer to retirement, you might prioritize higher yielding stocks that can provide you with a steady income to live on. Striking the right balance is all about finding stocks that match your financial goals and timeline. While you decide on what company's best for you, I've put together a mix of stocks from different industries, each chosen for its combination of dividend yield, growth potential, and long-term performance. And in the end, I'll show you how this carefully selected portfolio can get your sweet cheeks from a cozy home to a plush villa. Here's the breakdown of the portfolio. We've got Broadcom Incorporated, United Health Group Incorporated, UFP Industries Incorporated, Pool Corp, and Insperity Incorporated with their current dividend yields, dividend growth, and 10-year average share price appreciation. All of these companies were selected because they provide steady growing dividends while also offering a strong share price appreciation over the long term. By diversifying across different sectors, technology, healthcare, industrials, and consumer goods, you're protecting yourself from the volatility of any one sector while setting yourself up to benefit from the growth of multiple industries. In short, this portfolio offers a balanced approach. Companies like Broadcom and UFP Industries give you significant growth potential, while Insperity provides a higher yield for immediate income. Pool Corp and United Health round out the mix, offering both growth and stability in unique industries. By combining these companies, you're creating a portfolio that's built to weather market ups and downs, while still allowing you to take full advantage of the power of dividend reinvestments and compounding over time. So now that you're getting the hang of dividend investing, let's talk about one of the easiest ways to supercharge your portfolio: dividend reinvestment plans, or DRIPs. A DRIP is a program that automatically reinvests your dividends into more shares of the company without you having to manually buy new stocks. It's like putting your investments on autopilot. So how do you get into a DRIP? It's actually pretty simple. The most straightforward way is through your brokerage. Most major brokerages offer DRIP programs for free. You simply need to go into your account settings or call customer service and enroll. It's as simple as ticking a box, and from that moment on, any dividends you receive will automatically be reinvested. Whether it's Vanguard, Fidelity, or TD Ameritrade, these platforms make it easy to activate DRIP, and it often takes just a few minutes to set up. You don't even have to keep track of when dividends are paid. Your broker handles it all for you. And now the main question: what does the future look like when you and John start dividend investing and reinvesting through a DRIP? Well, if you play your cards right, it's a pretty bright future. Dividend investing is a long-term game. You're not looking for quick wins. You're building a financial future that will keep giving back for years, even decades. In the short term, it might feel like your portfolio's not growing as fast as you'd like. That's okay. The snowball effect takes time to build momentum. As you keep reinvesting those dividends and adding to your portfolio, the compounding power kicks in, and that's when things really start to take off. So here we go. It's time to pull $10,000 out of yours and John's pockets, and let's see how much this portfolio can transform your financial future. With an average dividend yield of 1.5% and impressive dividend growth of 23.73%, I can confidently say your portfolio is primed for long-term success. In the first year, your portfolio will be valued at $12,556. Fast forward 10 years, and the picture becomes a little more exciting. By now, you'll be receiving $1,128 per year in dividends. And with the dividends reinvested alongside capital appreciation, your total portfolio would be worth $97,219. At this point, your original $10,000 investment has grown nearly tenfold in value. Give it 10 more years, and in 20 years, things really get exciting. By now, your annual dividend income would be a substantial $10,571, as much as your initial investment in dividends alone. And your portfolio? It's grown to $941,534, nearly $1 million from a $10,000 start. After 30 years, your annual dividend income would be $98,718, which equates to a monthly income of $8,227. Your portfolio would now be worth $9,084,752. That's right, over $9 million simply by sticking to a disciplined approach of dividend investing, reinvesting, and letting time and the snowball effect work in your favor. Dividend investing shines during market fluctuations. While stock prices may drop, dividend-paying stocks often hold up better thanks to their steady income. As long as companies like Broadcom or United Health remain financially strong, you'll keep receiving dividends, offering a financial buffer in tough times.